Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about American Eagle Outfitters, Inc. annual report. American Eagle Outfitters, Inc. offers a diverse range of products and services through its various brands. The company's flagship brand, American Eagle, provides jeans, apparel, and accessories for women and men. In addition to this, Aerie and Offline by Aerie offer intimates, activewear, and swim collections. The company also operates under the Todd Snyder New York brand, which specializes in menswear products. Furthermore, Unsubscribed is a fashion clothing and accessories brand that complements American Eagle's offerings. These brands cater to different tastes and preferences, making American Eagle Outfitters, Inc. a one-stop destination for customers seeking various styles and products. In terms of sales channels, the company has a strong online presence through its websites, including www.i.com, www.aerie.com, www.toddsnyder.com, and www.unsubscribed.com. It also operates physical stores, concession-based shops within shops, wholesale markets, and licensed retail stores. This multi-channel approach enables American Eagle Outfitters, Inc. to reach a wide customer base and provide convenience through various sales channels. Overall, American Eagle Outfitters, Inc. is a leading specialty retailer that offers a broad range of products and services across multiple brands and sales channels. American Eagle Outfitters, Inc. market capitalization of $3 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that American Eagle Outfitters, Inc. holds a significant advantage in their industry. American Eagle Outfitters, Inc. trades at a higher price-to-earnings ratio of 16 times and a higher price-to-book ratio of 1.72 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 58% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 2.91%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through an analysis of the company's performance across various segments. Revenue growth is primarily driven by the Aerie segment, which experienced a significant increase in sales in 2026 compared to 2025, with a growth rate of 11.6%. Additionally, digital revenue saw a notable increase of 7% and total comparable sales rose by 3% for fiscal 2025. In contrast, revenue decline is attributed to the American Eagle segment, which experienced a decrease in sales in 2025 compared to 2024, with a decline rate of 0.8%. The Aerie segment also saw a decline in sales in 2026 compared to 2025, with a decline rate of 7.9%. Furthermore, the company's decision to close Quiet Platforms fulfillment centers and exit third-party contracts resulted in asset impairment charges and restructuring costs. The neutral/no impact section highlights pages that do not provide relevant information on primary drivers of revenue growth or decline. Overall, the analysis suggests that revenue growth is driven by strong performance in the Aerie segment and digital revenue, while revenue decline is attributed to underperformance in the American Eagle segment and other segments. Net income and profit margins experienced significant changes over the 3 fiscal years analyzed. Initially, net income decreased by $192 million, 42%, in fiscal 2025 compared to the previous year. This decline was attributed to various factors, including a decrease in consumer confidence and discretionary spending, increased costs due to commodity price volatility, and uncertainty surrounding tariffs and trade restrictions. In fiscal 2026, net income continued to decline, this time by $137.397 million, 42%, indicating a downward trend. The profit margins also suffered, with the gross profit margin decreasing by 270 basis points. This was largely due to lower sales in the American Eagle brand and increased investments in advertising. The operating income margin also saw a significant decrease of 390 basis points in fiscal 2026 compared to fiscal 2025. The reasons for these changes were multifaceted, including aggressive pricing and promotional activities by competitors, failure to maintain efficient fulfillment operations, and inability to execute key business priorities. These factors collectively contributed to the decline in net income and profit margins over the 3 fiscal years analyzed. The company's financial performance has been a subject of interest in recent years. A closer look at the data reveals that the company is indeed generating positive operating cash flow. This trend is evident from the fiscal year 2026 and 2025 reports. According to the data, the company generated $456,200 in positive operating cash flow for fiscal year 2026. Similarly, in fiscal year 2025, the company reported a positive operating cash flow of $476,800. These figures indicate that the company is consistently producing more cash than it consumes from its operations. This achievement is a testament to the company's efficient management and effective operational strategies. The ability to generate positive operating cash flow is crucial for any business, as it enables the company to invest in growth initiatives, pay off debts, and reward shareholders. Overall, the data suggests that the company is on a solid financial footing, with a strong foundation for future growth and success. The company's debt level and interest expenses have undergone some changes, but they are not significant enough to indicate a substantial shift. The long-term debt remains unchanged, according to the provided information. However, there is an asset-based revolving credit facility of up to $700 million that will expire in June 2027. Regarding operating lease liabilities, there has been a fluctuation between years, with a decrease from $326,571,000 in 2024 to $280,036,000 in 2025, and then an increase to $323,524,000 in 2026. Despite these changes, the overall debt level does not appear to have increased significantly. The interest expenses have also seen some fluctuations. The company's interest expense increased by 153% in 2026 compared to the previous year, resulting in a net change of $11,881,000. However, this increase is largely due to a significant jump from $1.592 million in 2025 to $7.272 million in 2026. Despite this increase, there is no clear indication that the company's debt level or interest expenses have changed significantly enough to raise concerns about its financial health. Management is optimistic about the company's outlook and strategy, citing successful lease renewals and a belief that pending legal matters will not have a material adverse effect on the company's position. The company plans to expand globally through licensed retail stores and concessions, with a focus on building a seamless shopping experience across all channels. To drive customer experience and operational efficiency, management is investing in digital capabilities, mobile technology, and omnichannel capabilities. This includes significant investments in mobile technology, digital marketing, and digital customer experience, as well as adapting to future changes in technology to remain competitive. Management also recognizes the importance of anticipating and responding to changing fashion-related trends and consumer tastes, and is prioritizing strategic pillars such as accelerated rewards tiers and omnichannel integration. The company plans to continue international expansion efforts, investing in technology and omnichannel capabilities, and developing the Aerie brand. In terms of financials, management expects capital expenditures to be in the range of $250 to $260 million for fiscal 2026, related to continued support of expansion efforts, stores, information technology upgrades, e-commerce investments, and supply chain enhancements. The company also plans to adopt new accounting standards effective for fiscal 2026 and 2027. Overall, management's strategy focuses on building a seamless shopping experience across all channels, investing in digital capabilities, and expanding globally through licensed retail stores and concessions. The company has a history of paying dividends to its shareholders. In fiscal 2025, the company paid out a quarterly cash dividend of $0 and 125 cents per share in all 4 quarters. This consistent payment schedule demonstrates the company's commitment to returning value to its investors. In addition to the quarterly payments, the company also disclosed its dividend payments for both fiscal 2024 and 2025. The amounts paid out were significant, with $96.5 million each being paid in fiscal 2024 and $83,825,000 and $96,455,000 respectively in fiscal 2025. These figures indicate that the company has a substantial dividend payout program in place. Overall, the company's payment of dividends suggests that it is prioritizing shareholder value and returning profits to its investors. Concerns about inventory buildup and supply chain disruption. The extracted summaries reveal a multitude of concerns regarding inventory buildup and supply chain disruption. On page 12, decreased demand for products and supply chain disruptions are mentioned as causes of increased inventories. This trend is echoed on page 22, where higher inventory levels are attributed to mismatches between sales forecasts and customer demand. Supply chain disruptions are also highlighted on pages 18 and 20, citing data center shutdowns, global health crises, labor disputes, insolvency of suppliers, trade restrictions, and economic uncertainties as potential causes. The impact of these disruptions is further emphasized by the mention of inventory write-down charges on page 36, totaling $70 million in fiscal 2025. Furthermore, pages 43 and 57 indicate that merchandise inventory often exceeds customer demand due to factors such as style, seasonal adaptation, changes in customer preference, or competition. This mismatch can lead to decreased profit margins and lost sales. The report also touches on the importance of supply chain infrastructure investments, with a decrease of $4,302, 24%, from FY 25 to FY 26 noted on page 41. Additionally, pages 61 and 85 mention inventory valuation methods and write-down charges related to restructuring international operations. Overall, these concerns are scattered throughout the report, indicating potential risks associated with inventory buildup or supply chain disruption that companies should be aware of and address proactively. That concludes the financial summary for American Eagle Outfitters, Inc. Feel free to comment below, and I will be happy to answer them when possible.